Welcome to Trading Nation. I'm Brian Sullivan. Pleased to be joined by Jim Paulsen, Chief Investment Strategist at the Leuthold Group. Jim, are you shocked and amazed or concerned or anything about this bull market, which just does not seem to quit?
Yeah, it keeps on a trucking. I think Brian, I'm kind of watching. Rather than watching the traditional signs for a bear, the Fed started to tighten and valuations are high and the recovery's old. I'm kind of watching the foundation of this unique bull and its pillars and waiting for them to crumble a little bit before I take the urge to get too bearish. There's been some unique aspects to this bull. One of them is just climbing a perpetual wall of worry. One of them is the rapid rotation of leadership we've had throughout, or lack of anything being in a trend for a really long time. And then the last thing is kind of the fact that we've been in this sweet spot where the economy is continuing to grow, even though we're at full employment, and we just have never aggravated inflation or interest rates, which would put a brake on this stock market. So I think until you break the wall of worry, until you create more of a trendy market where the bear has something to bite, where everyone's riding the same wave, and when we finally put some pressure on this market, like higher interest rates or higher dollar or less liquidity growth, I'm going to try to err, I think, more on the side of bullishness.
Well, those are coming. I mean, higher rates, unless something changes, the Federal Reserve expect, based on their projections, the quote dot plots, higher rates are likely. Is that what's going to finally derail this?
I think ultimately every post-war recovery has ended, Brian, with some semblance of overheat conditions. Escalating cost, particularly wage cost, rising inflation, which hurts the valuation of stocks, and then finally the need to reset rates higher. So I do think ultimately this bull market will end under that condition. But boy, we're a long ways from there. Right now the earnings yield on the stock market is twice as high as the 10-year bond yield. And that's a huge buffer against rising yields. There's some work we've done that suggests that the 10-year yield might have to get as high as 3.5% or in the upper threes before it really starts to bite in to the momentum of the economy as well as the stock market. So I do think that'll be the end game, but we're certainly not doing it yet with the 10-year sitting here about 2.3%.
A little bit off topic, but I've been kind of hot on the issue lately, which is how much do you think the rise of passive investing? I mean, Vanguard just said they have $4.7 trillion under management. Schwab, I just got an email, launched a new 1,000 stock ETF, the Schwab 1000. How much of this is, do you think, because the rise of passive investing, because mom and pop or institutional just throwing a couple $100 a month into the market and not even worried about, so they don't care about earnings, they don't care about the risk factors because it's just an automatic debit into a passive fund?
I do think that's mattered in different aspects of this marketplace. I do think they care. I still see evidence of a wall of worry or fear that still exists today. For example, in the last 6 months, the average net bull bear position between individual investors has been 0. It's still quite low. There's not a lot of bulls, even though the stock market's up 8% over that time and we've set multiple new record highs. But I think the passive investment funds, the biggest thing it's affected in my book is valuations. I think when you buy a stock, you're very keyed into its value. But when you decide I'm going to put more in the stock market and I'm going to buy an ETF to do that, you don't generally do an intensive analysis of valuations. So what we've had is the proliferation of ETF usage and indexation in the last 25 years. We have valuation levels that have been above the upper end of the range in the previous 125 years prior to that. We've had perpetual state of overvaluation in the last quarter century that might have a lot to do with the new usage of ETFs and index funds.
Yeah, and I guess what I'm asking, the flip side is if everybody decides something happens and they want to get out of the stock market, do you think it'll sort of flush the system and send us down more than we needed to be down? Because everyone's just selling the market. It's not like anybody's going to sell IBM. They sell the whole market, or the SPY, or the DIA, whatever it is.
Yeah. In some ways, Brian, I'm almost less nervous about it. It used to be One of the things I noticed this time is the lack of the trend that has been going on for so long that everyone's riding the same wave. So we don't have everyone sitting in the Nifty 50 today like in 72. We don't have everyone sitting in energy stocks like we did in the late 70s. We don't have everyone sitting in .com stocks in the 90s. We've had this constant rotation. Trump trades are on, then they're off, and defensive and dividend aristocrats are back, then they're back off, and the Trump trade's back. And I think that would concern me more about a concentrated bet than really just a diversified array of broad-based indexes that own the whole market. I think the bigger risk in this cycle is when people come out of the bond market in droves. That has not happened, but if we put that 10-year Treasury, for example, up over 3%, I think you're going to see a lot of people coming out of bonds. That might be the bigger risk than it is right now in the stock market.
Well, okay, we're on the record with that. A lot to discuss here. Jim Paulsen, we always appreciate your time. Thank you very much.
Thanks, Brian.
Folks, and thank you as always for tuning in to Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.